Hello and welcome. You're watching BQ Prime and I am Mimansa Verma. In the last few years, Indian financial institutions have gone big on adopting digital technology for seamless and efficient banking and payment services. But it is also true that a sizable portion of Indians have been defrauded in some way or the other. Now, to combat the financial frauds, financial institutions have had to redefine the compliance processes. In fact, an RTI response by a news organization showed that between 2014 and 2023, Indian banks lost rupees 4.7 lakh crore on account of frauds. We have Mr. S. Ramanathan, APEC Head of Market Planning, Financial Crime Compliance and Payments from LexisNexis Risk Solutions, joining us to talk about how much Indian financial institutions spend on an average to ensure financial crime compliance.
Thank you so much, Mimansa, for your question, and thank you for having us here today on your show. And we at LexisNexis Risk Solutions are completely with you on this quest. The problem with the fraud is not unique only to India. So let us take a step back and let us look at what the survey shows. So we know for a fact that when we query our institutional clients here in India, roughly about 95 crores is the average spend for each financial institution. So it's not the question of money, but it's also the question of scale. So when you look at scale, it comes from two particular attributes. A, the amount of clientele that the banks serve, and more, the amount of volumes that our banks have to contend here in India. So when you compare that as a whole, India has come a long way. What started off with the initial focus on KYC, or Know Your Customer, has then focused more attention on customer due diligence, CDD, enhanced due diligence as far as EDD, that's what we call it, and now grappling with this twin issues of cybercrime and, more importantly, stolen identities. So the field of financial crime has evolved in India. Second of all, you need to contend the fact that India as a whole has been developing over the last few years. As a middle economy and to now becoming the top 5 in the world, we are seeing the significant profile change of the population as a whole. And as a content, the risks also increase. So when you look at it primarily from a context of a local bank, which is like contending to the needs and interests of the local population, there has been the significant increase. So the last World Bank report denotes that India was the largest single net remitter of foreign exchange into the country. So that basically means cross-border fraud and remittances become a source for tapping into frauds. The second is obviously the explosion on digital payments. Hitherto, we have been used to working with traditional models, but with the global popularity of UPI and digital means of payment, you are now seeing a new typology emerge, which was not contended when the original regulations have been. We need to give credit to the Reserve Bank of India and the Government of India to come up with regulations to stop this and evolve this. The recent amendments in the KYC Act, as far as recognizing these changes, have been well noted. All in all, financial crime has been regulated by the FATF, the global body of the G20 and the world, which comes down to setting the rules as far as what financial crime compliance standards have to be. And India has been always noted as one of the pioneers to set the bar. In fact, India is right now going through the 4th phase of mutual evaluation, and we are supporting our clients, the leading banks in India, to help achieve their objectives. So, but there is still a significant way when we look at the population of India, when we look at the tier 1 banks that serve the marketplace, but also the tier 2 and the mid-tier, the local banks, which serve the wider populace. And there's this gap. So I'm not too surprised that with the statistic that you shared, and it's so not different from what we see rest of Asia. So financial crime compliance, as far as the world is concerned, is increasing. And as far as India is concerned, is also changing, which was traditionally a more of an identity KYC issue, has largely been put to rest thanks to the phenomenal development and success of the Aadhaar stack and the KYC interface. But now what's the next step is to get the digital identity in place. So that's where I see the recent amendments to the RBI KYC norms, which have been trying to align the Indian definitions of ultimate beneficial ownership with the international norms, and more importantly, getting the Companies Act and the RBI regulations to start talking in sync. You're going to see that.
Right, right. Fair enough, sir. You mentioned about RBI and their regulatory provisions or the rules that they can change. We'll touch upon that later in the conversation. But if we talk about costs, the report that LexisNexis Risk Solutions had released, it shows that per organization, the cost comes to about $11.5 million for an Indian organization, which is roughly 95 crore rupees. India's sample size in the survey is pretty low for now, only 5% in the survey. But what is your sense on the total cost? And if we look at if you compare India to comparable economies in Asia like Philippines and Indonesia, what are some of the, how do you draw that comparison? How does India stand in the Asian economies? And if we compare it to Philippines and Indonesia, how does India look like?
Thank you. That's a very great question. And the problem with statistics and surveys that's the devil is in the details. So the reality is that when you look at an organization like LexisNexis, and when we sample the world, we have only that limited bandwidth to really sample. India is itself almost like a mini universe. So, we can't really fully sample the population. But what we do is look at a kind of a cross mix between large, middle, and small organizations. And that's what our survey found. Now, the number that you see on your screen at $11.5 million, it's not too different from what we are seeing in the rest of Asia. There are obviously economies which are larger than us, but there are economies which are much lesser than us. But it all depends on the relative journey on financial inclusion. So, for instance, geographies which have a larger tendency to have digital transactions or high volume, or we have larger number of customers, you will see a far more spending as far as financial crime compliance is concerned. The aim and intention of our survey is not really to measure cost, but to really look at the reasons why that cost is incurred, how we can bring about better efficiency. So, Mimamsa, from that perspective, India tracks well. Given the demographic size it has, for the kind of complexities it faces, I think the average spend for an Indian organization as a whole, just not the cost on just the people on the actual spend on financial crime compliance, but the holistic cost, I think that tracks well compared to the rest of Asia. As far as Philippines and Indonesia are concerned, you particularly raised that. These countries are going through their own journey as far as their evolution as an economy is concerned, particularly Philippines. Let me tell you that they do not still have a unified national ID, and their government is right now working steadfastly, and that's one of the inspirations is what was achieved in India. So they are actually looking at how they can bring that unification of customer identification that can overall reduce the cost of compliance. So we at LexisNexis Risk Solutions are working with them and trying to give them this kind of pioneering ideas. But more importantly, also looking at Indonesia, where we are trying to look at the big challenge that they have faced as far as addressing a very diverse customer base. Indonesia is the world's largest archipelago, so they have customers over 14,000 islands. How do you get inclusion? So, that's one thing that we are working with the government of Indonesia. So each of the geographies have their own peculiar challenges. To look at just from a cost perspective would not be the right way to look at it, in my opinion.
Got it. Mr. Sivabalan, the report also says that the financial compliance in APAC region, the cost for financial compliance is high because of the expensive technology and labor costs, the high labor costs. So what are some of the key issues specific to India when it comes to complying with financial crime norms?
Very good question. Again, for any compliance program to be successful, there are three essential ingredients. The first and foremost is the people, right? So getting the right kind of people to sit in your program to ensure that you meet your regulatory objectives. The second is the process itself, how you ensure that compliance is delivered. And last is technology. for me, I think the people first come, and then the process and technology. Now, let me just spend a little time on each one of these pillars. So when you look at the people and in a compliance program or trying to ensure that we are able to achieve financial crime compliance, we need to ensure that they are appropriately hired and trained and able to perform their duties. The second part, obviously, in India, an extremely competitive labor market, is to retain the people. So retention of talent has been a crucial factor in differentiating how well a person can remain in the job. So there is a lot of competing demands. There's a lot of opportunities out there for a young person to pursue a career in compliance or not. So in a compliance program, when you look at it as a whole, it's actually a bell pyramid. So, a majority of people don't really necessarily sit at the start. So there's a bunch of freshers, but the bulk of them sit in the middle. So to get the right mix of cost and people becomes a big challenge. The second part is process. Now, financial crime historically has been relying on traditional data as far as when customers are onboarded. So historically, customers were onboarded in bank branches or agents were filling up traditional forms or paper-based KYC or such like that. Now, more and more customers are onboarding digitally. But having said that, process is quite complex. There are multiple touch points and there are multiple intermediaries. So the first part is how complex is your onboarding process? How many are the touch points that you have? And that basically brings to the next part, which is a risk-based approach, which is that how often your organization has actually conducted a risk-based approach to see how efficient your customer onboarding organization is. So that impacts the people aspect. How many people do you need to really get your customers in, and how many people you need to really manage them at the end, looking at the financial crime risk. And finally, is about how well integrated your organization is. Traditional banks still function in very much silos, and then they really don't talk with each other. Departments, operations, KYC, compliance, technology, they don't really talk to each other. So this creates a big gap. So the process element creates that gap. And finally, coming to technology. So technology is often touted as the panacea to all the problem that people and processes create. But the reality is that technology is the last element. So long as you get your people and processes mixed correct, technology can help that. And that's where, from two perspectives. So the first part is that right now we all accept with the explosion of digital transactions, digital is the way forward. There are multiple data which is available within the organization. The issue is that they get siloed. They get siloed into one particular process, or they get siloed into one particular department. And how do you harness both of that? So getting the data, unifying the data, and more importantly, augmenting the data. So what is augmenting of data? So when you onboard a customer, you're particularly trying to look at dynamic as far as the person is concerned, the income, and as far as the demographic. But we are also looking from a compliance perspective about all the financial crime identifiers. Are you rightly doing that? Or are we spending effort to duplicate that in a separate process? So to bring that unison is very critical. So long as we have conquered this augmentation, unification divide, we can come to the technology solution. And what we are looking at, the world-class organizations in India have been doing it, is that they have been trying to synergize these two activities and leveraging what the next generation technologies offers.
A lot of moving wheels. So my next question is, can this cost be minimized? Like, what are some of the strategies or any possibility that you would suggest to minimize the cost incurred on financial crime compliance?
So actually, we try to, again, attack this on three pillars. So going back to my original hypothesis of people, process, and technology. So looking at people, right, you need to really be able to get your people to focus on what their main objectives are. There are a whole lot of mundane activities that most of the financial crime compliance or fraud organization is involved in. Identifying patterns and trying to figure out, recurrent themes. But the reality is that there are now technology solutions that can help you do that. what we can really use our people to is to do more cross-training, more education, and more importantly, look at enhanced due diligence that can help further objective. The second is the processes. Like I said before, most of the compliance processes are siloed. They are split between multiple departments. So you need to get those data assets to talk very seamlessly together. To that, you need to have one framework that can unify them all. So having systems that can cut across organization layers and get the first line, second line, and third line of defense, as we call it in banks, aligned, it becomes very crucial. Finally, nonetheless, technology. Leveraging technology becomes crucial. Why is that important? Because more and more of transactions are now becoming digital. The last study that we did at the start of the year, we identified that almost 27% of the global trade right now is done to digital transactions. There's roughly around $16 trillion. So if you can imagine the volume of that kind of sums are flowing digitally, that means that there was no human intervention in its, except for its origination, but to its conclusion, because everything else was digitally settled. Why do we have manual processes then intervening? You need to look at it fundamentally different then. You need to create up solutions that can take care of that kind of volume. Secondly, we need to leverage the newer technologies. There are a lot of regulatory challenges as far as adoption of new technologies. Because regulators don't understand, but more importantly, banks themselves don't really understand how to implement them. So you need to have support of someone who understands these technologies, can implement in a practical, explainable way.
Mr. Sivabalan, this brings us to the last question. Do you think, because we touched upon this earlier in the chat, do you think there's something that RBI could do more to ensure that frauds, the financial frauds of such magnitude do not happen, and there is a need to tighten controls on financial institutions to ensure that there's no repeat of such instances?
So I think it's a very good question, Mimansa. But let me first commend the Reserve Bank of India and the Government of India for taking the leadership and recognizing this. In fact, Reserve Bank of India and the Government of India have been taking utmost steps to protect the population against the rise of frauds. In my discussions over the last few years, I've realized the Government of India has perfectly seized on to this issue. In fact, if you consult the last National Risk Assessment, frauds and cyber crimes were rated as the top risk, and it's out in the public domain. Anyone can consult and see. So at this point of time, all I can assure you is the Government of India and the Reserve Bank are fully seized and fully focused on tackling the menace of fraud. And the problem with fraud is that it's going to continue to evolve. It's not going to be something that will stop right now. The damage to the Indian economy is close to around $10 billion, is the estimate made in the NRA. But I feel that estimate is pretty conservative. It should be much higher than that. But having said that, what I really appreciate is the fact that not just the regulators or the government, but also the institutions are paying heed. We are seeing most of our top clients in India, and not only the top clients, but also the emerging clients in India pay attention to us and start having conversations on frauds.
Quite an insightful discussion. Thank you, Mr. Sivabalan, for speaking with us today. This was Mr. Ramanathan Sivabalan from LexisNexis Risk Solutions talking to us about the true cost of financial crime compliance in India. For more news and updates, keep watching BQ Prime.